Today is the 2nd of September, 2014, and this is episode 141. This program is intended for informational and educational purposes only. Cryptocurrency is new, highly experimental, and we're not experts, just obsessed companions walking the road towards a more peer-to-peer future.
Argentina is back in the news with the possibility of an imminent default on the sovereign debt of the country. This has been a saga that's unfolded over several months now, as they've been in discussions with creditors and under a court ruling to negotiate with creditors in a mediation in order to find a way to satisfy their creditors. And as far as I can tell, the last part of that was a ruling by the court forcing them into mediation, and no one showed up at the mediation meetings. And then the deadline passed yesterday, and presumably Argentina is now in default. I don't know if it's official yet, but essentially it's been heading in that direction for quite a while now. And this would be, I believe, the third default of Argentina in the last 30 years. Terrible situation, financial situation. And for Argentinians, the result of this has been another spike in the exchange rate. So now the official exchange rate is about 1/3 of what the unofficial black market exchange rate is, which I believe passed 12 pesos recently. So for example, if you visit Argentina and you have hard dollars, if you go to one of the official government endorsed licensed kiosks or to a bank to change your money, you're going to get about 5 pesos per dollar. But if you go to the person standing right next to the official kiosk, then you will get about 12 to 13 pesos per dollar. So a massive discrepancy between the official and the black market rate, which means also that for local Argentinians, their purchasing power is demolished. Everything that they buy from abroad, any goods that are coming from abroad are horrifically expensive. And now all of that is just going to get worse. It's a really harrowing situation, but for Argentinians, this isn't even a surprise or something new. It's a repeat of the same story that's happened already a couple of times in this generation.
Well, so the question that I always come back to when we look at examples like this is, why is this the best option for the various parties that are involved? Watching the ongoing sovereign default has been interesting because it seems like everyone should want a resolution, but in practice, that's not actually what happens. And it seems like most of the creditors are on board with some kind of reduction, except for some that aren't. And that's kind of messing up the whole thing. So, this reminds me a lot of undischargeable debts, just in any sort of situation. Whenever you have undischargeable debts, you have this kind of problem where both the debtor and the debt holder are just in a bad situation, and there doesn't seem to be a way out. So, why do we keep finding ourselves in this situation?
Well, you've got to look at this from a different perspective, which is, if you're a creditor to Argentina's sovereign debt, that means that you have an asset on your balance sheet, which is the repayment of that debt. So you bank on that. Essentially, the balance sheet of these organizations has an asset, which is the repayment of the debt, a long-term asset. And if you accept a default agreement, that forces you to revalue that asset at a new level. And that means accepting a smaller payment in the future. But for many of the organizations that Argentina owes money to, their balance sheet is in a pretty bad situation too. So if they accept a default, that forces them to recalculate things like their currency reserves, if they're an investment bank or that has some regulatory arrangement with the government where they have to keep certain assets in reserve. Well, now their asset list has grown smaller, and that means they need to keep other assets in reserve to make up for the difference. And if their balance sheet is really, really bad, that may tip them over into a position where they start defaulting on their own obligations as a result of this. And it causes a ripple effect through the economy. And that's essentially what we saw with Lehman Brothers, was that, once one organization finally gives up and says, we simply can't respond to these debt obligations, then all of the other organizations that were expecting those payments start rolling over, and that contagion, as it was called at the time, spreads through the economy. Part of the reason there are holdouts in the Argentina default is that they simply can't accept a smaller payment or make a deal, because that would be a very bad outcome for them. And, a default isn't any better, but they're holding out because they're hoping that somehow Argentina will manage to get someone to come to their rescue and bail them out in time for them to balance all their assets. And, as long as that hope remains, that maybe there's going to be a deal with the IMF and an injection of capital or somebody else, then there'll be holdouts. And that's really what happens in any situation. So, unfortunately, nobody came to the rescue of Argentina. As a result, I think today Standard & Poor, one of the rating agencies, rated Argentina as in default.
So it's better to have the funds be unavailable, but still technically owed to them, rather than making it real and making it something that could actually be used if a guy wanted to use it, but lowering the value and then unbalancing this very precarious debt situation that, a lot of these creditors themselves are also in.
Right.
Is that right?
Yeah. So essentially everybody is up to their neck in debt, and they have a certain amount of debt coming in that could push them underwater. And at the same time, they've got a certain number of assets that are keeping them like a flotation device above water. So if you give up one of your flotation devices, you sink. And if you accept that one of the debts that's owed to you is no longer there, then that forces you to restructure your own balance sheet, and that has a ripple effect. It's basically like a number of people all trying to tread water, and one of them starts going under and pulls the others with them. That's the situation. As we've seen this cascade effect, there's basically no room in the global economy for these kinds of failures, because everybody is up to their ears in debt and doesn't have any room to absorb any shock. The system itself has become incredibly fragile. And this is not surprising because, after the last crisis, none of the structural problems were really fixed. The banks that were too big became even bigger. Their debt loads increased, and all of the national governments that started printing money to cover up the problems simply escalated their own debt situation, so that now they have no room, even as the economic crisis continues completely unabated 6 years in, and in a very precarious situation. The next time we have a crisis, no one can bail anyone out.
Well, but with that sort of thing in mind, wouldn't that, any potential rescue is just more of the same. It's another bailout, which means more borrowed money that, again, these people who are doing the bailing out are probably borrowing themselves from other people who are already borrowing it. So it seems like at best what can happen here is like the bag holder changes a little bit, and this round of creditors to Argentina gets bailed out, but it comes by bringing in a whole new swath.
Yeah. And, you might think that strategy doesn't work. And it certainly doesn't. In the long run, it can't possibly work. The bag doesn't go away just because you shifted it down the line. Surprisingly, at the same time, it has worked. And the way it's worked is that 6 years after the crisis in 2008, we've pumped $2 trillion into the U.S. economy in terms of debt, at least. The big banks have gotten even bigger. The debt musical chairs has played for 6 years and no one collapsed. Of course, now everyone's in an even more precarious situation than in 2008. And so the slightest shock to the system could send all of the dominoes tumbling. But, it worked in terms of postponing the reckoning by 6 years. And of course, at the same time, making that reckoning even bigger. It means that the next crisis will be much bigger than the previous crisis because it's been delayed for 6 years.
One of the reasons why cryptocurrency is appealing to a lot of people initially is because they're not attached to the existing systems, whatever that system may be. And so a country like Argentina seems like as it continues down this rabbit hole and doesn't seem to be getting what it considers fair treatment, is there a reason to continue participating in this sort of system? Is a solution like Bitcoin or perhaps a cryptocurrency that's created, specifically for a country or by a country, Does that offer some solutions here?
Well, not on a national level. And I think that's the critical issue here, which is on a national level, there is no solution other than accepting reality, which is the country is bankrupt.
Isn't that what a default is attempting to do? It's attempting to reckon what is perceived, what is owed, with what is available, what is real. So isn't Argentina, through this action, trying to bring reality back into the situation? And it's their creditors, it seems like, who are the ones that do not benefit from that at all.
Well, yes and no, because sovereign default has very, very serious repercussions. Essentially, what happens next is that Argentina's interest rates for creating new debt for bonds skyrocket. So Argentina can no longer borrow money on the international markets because their bonds won't sell unless enormous, and enormous to a point where the country can't service its debt at all, which it already can't. So what happens next is that the government runs out of money. So then any services provided by the government essentially stop. That means no pensions for pensioners. That means no public services. That means anything that's related to public services will cease to function. Government offices close, copyright offices, patent offices, land registry, loan systems, government administration, the military, the schools where there are public schools, the public hospitals, all of the pensioners, all of those things basically stop because there's no money for any of that. And those kinds of consequences end up hitting the poorest and neediest in a society harder than everybody else because they have no disposable income or savings to weather such a blow. So suddenly grandma doesn't get her pension, but doesn't have any other means to survive. And you end up with people becoming homeless and starving and literally not having food. So this isn't just a theoretical rebalancing of a balance sheet. This basically means that a very large number of people are immediately affected by these situations. Now, you can't fix that with cryptocurrencies at the national level because the underlying problem is borrowing beyond the means of the country, and at the same time, a form of parasitic capitalism that sucks countries dry and enriches a very small sliver of the population. The big players who have done this to many other countries are quite present in Argentina's story as well. But you can change this for individuals. The difference is that in the past, when these things happen, the country takes all of its population hostage. This time around, however, there will be a very, 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 very small percentage of the population that will be able to retain their wealth in the form of either hard currency that they've smuggled into the country or cryptocurrency that they don't need to smuggle. They can build on their own computers. And so what that means is there's now a relief valve, at least on an individual basis, that allows those people to escape the consequences of the national default and opt out of the national economy in some way, and essentially create a gray economy that operates on different currencies, as you see in these situations.
I mean, really, it's just a money layer for the internet is really just the cleanest way to think about it. So yeah, in that way, it lets anybody opt essentially out, as much as they want of their local currency or their local situation and opt into the one that's shared by the entire internet using base. But I do think it seems like there are a lot of problems that come up because of the way that we handle money, that countries handle money. And a lot of it has to do with irresponsibility, but a lot of that is because it's all about global trade, and because it's actually, our credit systems enable that. They enable countries to spend beyond their means. That's what I come back to, is that it seems like if the problem is that countries can't responsibly use the funds that they actually have, then cryptocurrency might present a kind of transparency layer where you could have trust in otherwise currencies that you wouldn't be able to trust because they're being, administered by people who can do just whatever they want. But if you have programmatic money, if you have money where the fundamentals can be, set at the beginning and then cannot be changed by the bureaucrats, then maybe that's a way out of the problem
I think
in
that
general.
what this also reveals is a system of perverse incentives that cause government to respond to exactly the opposite incentive of what the people within that country need or want. So let's take the scenario. Let's look at this from two different perspectives. One perspective is an Argentinian saver, and the other perspective is the Argentinian treasury, right? So as far as the Argentinian treasury is concerned, when you have debt denominated in pesos, so via the exchange rate in US dollars, inflation is good. Inflation allows you to pay less in the future than you are paying now in terms of debt. It allows you to dilute the debt, erode the debt. So that, if you owe 1 million pesos today and that 1 million pesos is worth half as much in the future, and your country's GDP remains the same, then you're able to service that debt with half as much in a tax base than you would otherwise, right? So your interest payments, your debt servicing payments are essentially reduced in half because your currency is worth half what it was. And you dilute the debt. So the treasury is incentivized effectively, as are the big banks and anybody who holds large amounts of debt. And that's a given in large global economies, is that they're debt based. So anyone who holds large amounts of debt wants to see the value of money eroded over time, which allows the cost of the debt to be eroded over time. Now turn it around and look at it from the perspective of a saver. That means that their savings are being destroyed. So in order for the government to service its debt, it's destroying the value of the currency by printing more currency. And that destroys the value of the currency in everybody's savings account, but also in all of the assets that they own, their homes, their businesses, their capital equipment, everything that hasn't yet been capitalized and used in a productive way in the economy essentially starts eroding because of inflation. So you have this perverse situation where governments are incentivized to destroy the value of money through inflation against the needs of their citizens who have savings, who lose the value of their savings. And that's why, putting the control over inflation in the hands of governments has always been a bad idea. The idea of independent central banks is to avoid exactly that, to create a layer of essentially separation between the elected officials who may have weird incentives and the central banks to make them independent. The problem, of course, is that they're independent of the elected officials, but they're not independent of the bank members that make them up. So they end up being even more corrupt than the elected officials, and there's no recourse for citizens to fix that. They become outside the democratic process. I don't get to vote for the Federal Reserve chairman, and effectively, neither do my elected officials. Effectively, the Federal Reserve is a private institution run by private banks that get to make the decisions, and they make the decisions that serve them most. Since all of these institutions have enormous amounts of debt outstanding, is to dilute the value of money by printing endless money, especially since they receive the money that they print. and that destroys the currency.
It's a pretty good gig if you could get it.
It's a pretty good gig if you can get it, right. The best way to rob a bank nowadays is not to walk in the front door armed to the teeth. It's to get a banking license and buy a bank, and then you can rob it blind, and you get invited to Davos, to rub elbows with the bigwigs and pretend that you're a global financier of gravitas and serious opinions, also known, in my mind at least, as a criminal. And, the biggest criminals walking this planet wear very expensive suits and never get prosecuted. And that's basically the reality of the debt-based central bank system. Cryptocurrencies offer an alternative. Predictable money supply means that you can't have that scenario unfolding because no one can print money.
Now, so on that same note, the Argentinian currency is pegged to the dollar, at least officially. And at the beginning of this conversation, we talked about how, you mentioned that you can buy it from the window or you can buy it from the guy, standing next to the window, and the rates are different. People have chosen to peg to the dollar because it's the largest currency. It's the reserve currency. It's seen as being very stable. And yet it has this highly inflationary policy. So by pegging to it, you still can print money. I wonder, what do you think about the idea of a country pegging to Bitcoin or another cryptocurrency? Bitcoin seems like the obvious choice. Would that have, what would it do pegging a currency to a deflationary currency?
The problem is that pegging is an arbitrary decision that you can only make in the face of a market that accepts that decision. If you try to peg a currency to a value that doesn't represent the actual value of the currency, what you're going to do is you're going to create an enormous flow of money from one currency to the other because of arbitrage. So, if, for example, take the peso that's sold for 5 pesos a dollar at the store and then 12 pesos a dollar at the other. Well, as you can see, that creates an incentive to buy dollars at the official rate by selling 5 pesos and buying $1, and then sell them at the unofficial rate and get 12 pesos back. And you just made a 2.5 times return on your investment with no risk.
So the problem is that you can do this, but the only way that you're not fighting the tide is if you do it in a way that actually reflects reality as opposed to reflects the value that you would like it to be. So if you say this penny equals $100 and I'll trade it to anybody, somebody probably is going to come along and say, sure, here's some pennies, give me hundreds of dollars. But that doesn't, but you've identified the value wrong.
Right, exactly. And the only way that can work is by creating barriers to the currency flow. So for example, when you go into Argentina, when I visited last November, I remember one thing that was very interesting was the line at customs. I don't know if you remember, when you travel abroad and you come back into the US, it takes a very long time to get your luggage and a very long time to get through the line where they check your passports because they're very concerned about who gets into the country. But then once you get to customs, they do a relatively cursory check. They're checking for a few types of contraband, but mostly in the US, they're checking for agricultural pests and things like that. So you don't bring some kind of pest that's not present in the North American continent into the country and then cause, some horrible disease to spread among fruit trees or something like that, which has happened many times in the past. So you can see just by glancing at the lines and the length of the lines, you can see where the country's priorities lie, right, in terms of what they're allowing through the border. So I visited Argentina in November, and the passport check took a matter of a minute or so. And then I got to customs where I stood in line for about 45 minutes. And during those 45 minutes, every bag was scanned. Every third bag was opened up by customs officials. And there were signs everywhere that reminded everyone of the very, very strict limits on bringing foreign currency into the country. It was clear from that exercise that the primary focus of the entire border apparatus was preventing hard currency from entering the country. And the reason for that is very simple, because if you bring hard currency into the country, you go to an exchange point, you sell it in the black market at 12 pesos, and then you go buy back double the amount at the official exchange store. So you can profit from that flow of money. So the more money that goes into the country or leaves the country, the more that flow gets accelerated. Foreign currency reserves flying out of the country because they want to convert them.
Flying out, I think that's a really important point to reference here too, because Venezuela is another interesting example that's had currency controls on. And one of the ways that they enact that is they make it so you're only allowed to buy foreign currency at the official rate if that rate, if you're like leaving the country or doing something like that, doing some sort of travel. And so what happened for a while in Venezuela, and this also happened in Iceland because they have similar capital controls, is that people would essentially just buy tickets and then take their tickets so that they could get their dollars at the official rate, and then wouldn't go anywhere, or would go somewhere just with credit cards, buy a bunch of currency with cash advances essentially, and then bring it back with them in their bags because that was the most effective thing you could do in order to profit. Basically, it's more effective than having a job.
It creates all of these weird incentives that cause massive misallocations of capital, all, essentially for the purpose of adjusting through all of these other means, the discrepancy between the actual purchasing power value of the currency and what the pegged rate is. You deny reality, and reality tries to intrude through a million little channels, all of which kind of distort the picture. And what that does is it does tremendous damage to the economy, because pricing is the means by which resources get allocated to the most efficient investment that generates the best return. And if you distort that signal, what it does is it misallocates capital on a massive scale. So people do things like, for example, in Argentina, where people buy 3 or 4 brand new cars, drive them off the dealership lot, and the moment they drive them off, they double in value, which shouldn't happen. And the reason it happens is because every other form of capital preservation is destroyed. So hard assets become the only form of capital reservation. So people buy washing machines and cars, put them under tarps and store them in their gardens, and that's their savings account. And that's an insane situation that is created purely out of these perverse incentives. Think of it this way. It's like you have 2 containers full of water, right? And you connect them with a pipe. And then you take one container and you drop it 3 feet to a lower level. And you say, well, I still think they're at the same level. Well, you may think that, but the water flow will think otherwise, right? It's going to start siphoning from the one container to the other. And the only way to try and stop that is to put a dam in the way and say, no, I'm not going to let that flow happen. But, in this particular case, you're talking about economies. So there are a million little pipes connecting the 2 containers. And so if you plug one up, it flows through the others. And eventually it starts amplifying the flows through channels that should never have flow through them in that direction. And you get all of this weird effect happening. So that's what pegging is. And you can't really do that for very long, because the damaging effects just keep getting bigger and bigger and bigger. And it destroys the value of the economy, but it also causes all kinds of economic activity to grind to a halt, and all kinds of non-productive economic activity, which are just different forms of arbitrage, to start accelerating until eventually, it's all fake. By the way, this is happening right here in the US right now. So what happens when the Federal Reserve issues just a bit more than $1.5 trillion through the quantitative easing program since 2009, and gives that to banks to allocate, banks that already have significant problems on their balance sheets? Well, they start allocating it in ways that inflates their balance sheet in order to avoid default. And they do that chasing yield, essentially. So the economy's productivity hasn't increased, but you've just poured a whole bunch of money into the economy. The same structural problems exist, but now you've got this enormous flow of money flowing into the economy on a monthly basis, given to the same actors who misallocated capital before, and you allow them to misallocate capital again. What happens then is that enormous amount of liquidity starts sloshing around the economy. First, it chases the stock market to record highs, until you're investing in all kinds of companies that have no business, no plan, no product, no revenue. But you're investing just because everybody else is investing in them too, because they have to put their money somewhere. And then, you start inflating the real estate bubble. And then we've seen the student loan bubble being inflated. We've seen now the auto loan bubble being inflated. You can go out and get a car lease, and you can get car financing with 0% down, no credit checks, no background checks. Essentially, subprime auto loans have exploded. And why have they exploded? Because a giant flow of money was looking for somewhere to sit. And since there wasn't anything productive in the economy for it to be invested in, it flows into and starts inflating every single asset bubble there is. And right now, you look at what hedge funds are doing, what investment companies are doing, they've run out of places to allocate that capital. So all of that money sloshing around inflated all of these bubbles. And at some point soon, they're going to start bursting. And when they do, now you have an even bigger wave of defaults caused by this. So essentially, to fix the one problem, which was risk-taking and misallocation of capital by banks that, because of the repeal of Glass-Steagall, because of many other effects that cause financialization to be more profitable than investment in productive activities. And in order to fix that, we put a fire hose of $1 trillion into their hands and just gave them a new flood of money, which they went and misallocated even more perversely than before into an even bigger casino game of high frequency trading and algorithmic trading and front running transactions into a fake stock market that has nothing to do with people's actual jobs and employment and productivity. Well, guess what's going to happen next?
Bingo.
Bingo. Yeah. No bankers are going to go to jail. All of this is perfectly legal. But of course, the middle class
actually is kind of, yeah, right. No, okay. So yes, that's completely right. I think that you're completely right. And I think that this is obvious at this point. And so the question that I always come back to with all of this stuff is, can such a system that has behaved in such a way even save itself? I mean, can it do anything at this point? Or is it just, we're just kind of waiting for this train wreck to keep playing out and finally really go off the tracks?
Well, the problem is that it's accelerating, right? So when it does go off the tracks, the crash is going to be even more spectacular than the previous round. So essentially, we've signed up for an even bigger mess this time around 6 years later than we had in 2008. And that's going to hurt a lot of people. The whole point of a free market is the idea that unproductive activities fail quickly, fail soon, fail early, and fail cheap, so that their ashes can become fertilizer for the next round of companies. And if you prevent them from failing, just like allowing a forest to build up by preventing all forest fires, eventually you have a massive conflagration that burns everything to the ground and turns the ground into glass. And then it doesn't matter if there's fertilizer, because the ground is glass and nothing can grow there for the next 15 years. So, that's really what's happening in the economy here. In order to prevent some small fires, we created bigger ones. And when the bigger ones started burning out of control, we put those out and prevented even bigger ones. And now we've got a tinderbox.
Thanks for listening to episode 141 of Let's Talk Bitcoin. Content for today's episode was provided by Andreas M. Antonopoulos and Adam B. Levine. This episode was edited by Adam Levine, and music was provided by General Fuzz. This episode was sponsored by CryptoKit.com, and the magic word is outage. That's OUTAGE. Outage, as in power outage, which was how I spent my morning. Oh, the joys of country living. See you next time.